Okay, so now we're going to take a look at problem 9-17. So we're given a balance sheet for our company as of June 30th, and then we're given some information on the next quarter. So the following additional information. Estimated sales for July, August, September, and October are given. All sales are on credit, and all credit sales are collected. Each month's credit sales are collected 30% in the month of sale and 70% in the month following the sale. All of the accounts receivable at June 30th will be collected in July. Each month's ending inventory must equal 40% of the cost of next month's sales. The cost of goods sold is 65% of sales. The company pays for 50% of its purchases in the month and 50% the month following. All accounts payable at June 30th will be paid in July. Monthly selling and admin expenses are $65,000 each month, but $5,000 of this is depreciation. The remaining relates to expenses that will be paid in the month they are incurred. The company does not plan to borrow or pay or declare dividends during the quarter. It does not plan to issue any common shares or repurchase shares. Okay, so the first thing we are asked is to prepare a schedule of cash collections for July, August, and September, and then also the total for the quarter. So, cash collections. Our cash collections are going to come from your sales. So here we're told that all sales are on credit and all credit sales are collected. So there's no cash sales. So basically we just have to look at the sales for the month. How much of that, so if sales for July, for example, are $200,000, we're going to collect 30% of that in the month, and we're going to collect 70% of that $200,000 in August. So we do that for each month, but you also remember that there already are accounts receivable of $126,000, and it says that will be collected in July. So if we go over, so in July we're going to collect the accounts receivable from June, $126,000. We're also going to collect 30% of July sales, and July sales were $200,000, so we're going to collect that much in July. In August, we're going to collect 70% of the July sales that were on credit, and we're going to collect 30% of the current month sales of $220,000. And then in September, we're going to collect the remaining 70% of our August sales, and we're going to collect 30% of the current month sales. Now you notice here we don't have the 70%. The 70% of September will be collected in October. So just kind of keep this in the back of your mind, because the question will also asks for us to do an income statement and balance sheet. So this is something, if I was doing this question, I would make a little note somewhere or a little jot down that our accounts receivable is going to be the remainder of the September sales that we haven't collected. So that's all we need to do for our cash collections, and then you can total them up for each month and total them then for the quarter. Part 2. Prepare a merchandise purchases budget for July, August, and September and a total for the quarter. So the merchandise purchases budget. So first thing we need to do, let's go back to the question. Each month's ending inventory must equal 40% of the cost of next month's sales. So how do we determine this? The cost of goods sold is 65% of sales. All right, so our sales for July, let's go back. 200,000 in July, 220, 210, and 230. So our sales for July is 200,000. So 65% of that 200,000, which we got from the question here, cost of goods sold is 65% of sales. So 65% of the 200,000 is 130,000. So that's our budgeted cost of goods sold. Our desired ending inventory then is 40% of the cost of next month's sales. So 40% of next month's sales. So here for August, we did the same thing. We took the sales times the sales here, 220,000 times 65%. So we do that for each month to get our budgeted cost of goods sold. Then our desired ending inventory is 40% of the next month's cost of goods sold here. And we actually have October's numbers, so we can work out what the ending inventory is in September. So our total needs then are what we need for the month, plus our desired ending inventory is our total need. But what do we already have in our beginning inventory? We're given the number 52,000 up here, inventory 52,000. So that's our beginning for July. So if we need 187,200, we already have 52,000, so we need to purchase 135,200. August, again, you just take your sales times your 65% to get 143,000. Our desired ending inventory is 40% of the following month, so 40% of the 136,500. Add these together to get the need for the month. But you already have some in beginning inventory, so your beginning inventory number comes from the previous month. So this is what we're required to purchase. Again, I wanted to point out that our total for your desired ending inventory, it's not a total of the 3 months. It's desired ending inventory at the last period in that quarter, so 59,800. And our beginning inventory is the beginning inventory for the first period in that quarter, so the 52,000. The rest of these are numbers that are just added across, but don't forget your ending inventory and beginning inventory. They're not added across. They're the last period and the first period. We are also then prepare a schedule of expected cash disbursements and then the total for the quarter. So your cash disbursements are going to come from your purchases that you made, but it tells us here the company pays for 50% of its purchases in the month of the purchase and the remaining 50% in the month following. All of the accounts payable at June 30th will be paid in July. So the first thing in July, we're going to pay the accounts payable from June. We look up to our statements, and accounts payable 61,100. And then we're going to pay for 50% of our July purchases, so 135,200. 50% of that's going to be paid for in the current month. 50% of that July purchases will be paid in August. In August, we're going to pay for 50% of the current month of August, and we're going to pay the July and the 50% of the current month August. In September, we pay the remaining 50% of August, and we pay the 50% of September. Again, keeping in mind that the other 50% for September will be paid in October. That's going to be in accounts payable on our statements. So just kind of keep that in the back of your mind when we're doing our statements. Because now it asks us to prepare an income statement for the quarter ended using the absorption format shown in Schedule 9. So, scroll down here. So the income statement, now when you're doing these on any kind of test that you would hand in, I want to see this. I want to see the name, income statement for the quarter ended. There are a little bit of a mark allotted to this kind of stuff. So we'll get the first thing on our income statement is our sales. So the sales are given to us in the question, 200,000, 220, and 210 for the quarter. So sales less cost of goods sold, and our cost of goods sold was worked out right here, budgeted cost of goods sold. So 130, 143, and 136 adds up to 409,500. Sales less cost of goods sold is your gross margin. Then we deduct selling and administrative expenses, and there's 65,000 times 3 months. We're given that in the question. Monthly selling and administrative expenses are 65,000. 5,000 of that is depreciation, 6,000 are actual cash expenses that month. But for the purposes of the income statement, $65,000 times 3 months. So gross margin less our selling and admin expenses is our operating income. There is no interest. They say there's no, I believe they told us here, they don't plan to borrow money, nothing like that. So there's no interest. So our net income, $25,500. Then we're asked to prepare the balance sheet as of September 30th. So for our balance sheet, cash. So we have to go back. So we started off with cash of $80,000. And then what else affected our cash? We started off with 80. We're expected cash collections in total of $609,000. So we had 80. We're expected to receive $609,000, but we're also expected to pay out $407,550. And we're also told that of that monthly selling and admin expenses, it says $65,000, but $5,000 was non-cash. It's depreciation. So $60,000 of that is cash that will be going out. So $60,000 for each month for 3 months. So we add and subtract all this together to get $101,450. Our accounts receivable at the end of September, like I had pointed out when we did this up here, our accounts receivable is September sales. So $210,000 times 70%. Inventory is $59,800, and that is from our merchandise purchases budget, our desired ending inventory. So at the end of that quarter, we want to have $59,800 in ending inventory. Plant and equipment. So we were over in the information that was given, $200,000, but we also know that there's $5,000 depreciation each month. So $200,000 less depreciation for each month gives us our total assets. Then under liabilities and shareholders' equity, we have our accounts payable, and again we pointed this out earlier, but it's your September purchases times 50%, because 50% of that is going to be paid in the month following, so $70,850. Common shares, which were given back here, and we were told there wasn't going to be, there's no dividends or anything, and no shares issued, nothing like that. And retained earnings, you take your retained earnings that we had from the previous quarter, and then our net income for this quarter, to get our total liability and shareholders' equity, and we're done for that question.